Hello students, welcome to the lecture number 6 of Strategic Performance Management. So as you know, we have started our chapter number 1, that is Introduction to Strategic Performance Management, right? And what we were learning is tools for financial performance analysis, right? We were learning tools for financial performance analysis. I told you that in our syllabus we have to learn 5 tools. We have to learn 5 tools. The first one was comparative financial analysis. Then common size statements, right? The third one was trend analysis. Fourth is cash flow statement and analysis. And the last one is ratio analysis, right? So we have already completed the first 3. We have completed comparative statements, common size statements and trend analysis, right? So what we were learning? Cash flow statement and its analysis. Currently, we are learning cash flow statements and its analysis. So as I told you, question never comes from cash flow statement, but if it comes, I have gave you the overview how to solve that question. How to solve cash flow statement. I have already gave you the overview of cash flow statement. Then I also told you that in cash flow statement and analysis, we have to learn 2 concepts. We have to learn 2 concepts. Free cash flow to the firm, FCFF, and free cash flow to equity, FCFE. So we have to learn 2 concepts, FCFF and FCFE. So these concepts are very, very important in business valuation. So in business valuation, we will learn it in detail. But here we have to learn only formula. Okay, we have to learn only formula. So I will explain you the formula and also 2 illustrations are given. But in BV, in business valuation, we will learn it in detail. We will learn whole concept in detail. Okay. For now, I am going to tell you the formula and the meaning behind the formula, how it is derived. Okay. So the first concept is FCFF. See what is given in book. In cash flow analysis, free cash flow is an important measure. Okay, free cash flow. Cash which is freely available. Cash which is freely available. Cash in hand. Okay, it is derived by deducting the capital expenditure undertaken during the year from the company's operating cash flows. The free cash flow, listen one thing. This line, it is derived by deducting the capital expenditure. I will explain you with the formula. Okay. Come to the next line. The free cash flow to the firm and free cash flow to equity are 2 precise measures of free cash flow. Under free cash flow, we have to learn 2 concepts. Free cash flow to the firm and free cash flow to the equity. As they specifically identify for whom cash is available. 2. That means we have to learn 2 concepts, right? FCFF and FCFE. So FCFF, the name itself suggests free cash flow to the firm. That means cash which is available freely for the whole firm. And firm includes everyone. Debenture holders, the debt holders and the equity holders, right? But in FCFE, free cash flow to equity, the name itself says the cash which is available for equity shareholders only, not for debt holders. Cash which is available for equity shareholders, not debt holders. Okay. See. Come to the next paragraph, free cash flow to the firm. Free cash flow to the firm. Very easy concepts. Very easy concepts. These are very easy concepts. Okay. Free cash flow to the firm. Free cash flow to the firm is cash that is available to equity and debt holders. Equity and the debt holders. After the company has met all its operating expenses and satisfied its capital expenditure and working capital requirements. See, if the company is having some cash, out of which it has paid all its operating expenses, it has paid all the operating expenses, it has also deducted working capital investment, it has also deducted capital expenditure. After deducting everything, whatever cash is available for the firm is FCFF, free cash flow to the firm. Now it is freely available. We don't have to give it to anyone. We don't have to do any expenditure now. It is available for the firm. FCFF, free cash flow to the firm. It is freely available to the firm. Now we don't have to do any of the expenditure. Okay. So this is FCFF. Okay. After incurring every expenditure, whether it is working capital, that is day-to-day expenses expenditure, or day-to-day expenditure, and capital expenditure also. After that, whatever is available to us, whatever is available for the firm, for the debt holders and equity holders both, it is FCFF. Okay. So the formula is FCFF is equals to NI. NI means net income. NI means net income. I will tell you what is net income. Plus non-cash expenses. Just see the formula for now, then I will explain you. Plus interest into 1 minus tax. I will also tell you why interest is added. Minus working capital investment, that is whatever we have taken for expenditure of day to day, whatever we have taken for day to day expenditure, minus fixed capital investment, that is capital expenditure. This is the formula. Okay. Now I am going to explain you that what is the meaning behind the formula, how this formula came. Okay. See, free cash flow to firm. Free cash flow to firm. What it is saying? The formula says net income plus non-cash expenses plus interest net of tax minus working capital investment minus fixed capital investment. Okay, this is our formula. So how this formula came? How this formula came? See, if you remember the income statement, what is the format of income statement? See, first of all, sales is taken. Sales is taken. This is our revenue. Whatever we are earning, whatever we are getting, minus cost of goods sold. Okay, minus cost of goods sold. Then comes gross profit. After deducting cost from sales comes gross profit. Okay, this is our gross profit. And from our gross profit we deduct operating expenses. We deduct our operating expenses. Then comes net profit. But before net profit, it is EBIT, earnings before interest and tax. In this operating expenses, we have not included interest and tax yet. We have not included interest and tax yet. All other operating expenses are deducted. Okay. Then comes EBIT, earnings before interest and tax. So now we have this much profit. We have this much profit available for the firm. This is our profit. From this profit, now we have to pay the debt holders and we have to pay tax, right? We have to pay interest to debt holders and we have to pay tax. Now, less interest, it will come EBT, earnings before tax. Okay, earnings before tax. When we deduct interest from EBIT, it becomes EBT, earnings before tax. Now, we have to deduct tax. We have to deduct tax from EBT. Then this is the final net profit, that is EAT, earnings after tax or profit after tax. Earnings or profit after tax. Okay. So can we say, if we have deducted interest, so we have paid the debt holders. Okay, we have paid the debt holders. Now can you say that this is available, this money is available, this profit is available for shareholders now? This is for shareholders now, for preference shareholders and for equity shareholders, right? This amount, whatever comes, is available for shareholders now. Do you agree? Okay, so this is our net income. This is our net income, out of which first we will deduct preference dividend, then we will pay to equity holders. But in this concept, FCFF and FCFE, we are not taking in picture preference shareholders. We are not taking preference shareholders in the picture. Okay, we are considering only two people, debt holders and shareholders, equity shareholders. Okay, so can we assume that this income is for shareholders now, for equity shareholders? Okay, so this is our net income. So whatever figure comes here, we have to take in net income here. So it will be EAT. Net income means earnings after tax. Now see one thing. Here we have deducted operating expenses. Before that, listen one more thing. I told you this EBIT, it is available for the firm now. This profit is for firm now. Okay. So it is for the debenture holders also, debt holders also, and it is for the equity shareholders also, right? So we have to come to this point only. When we say free cash flow to the firm as a whole, so we have to come to this point. So why not we consider EBIT, this as FCFF? Why don't we consider EBIT as FCFF? Because we have to pay tax. We have to pay tax. We have to pay tax. Tax is for outsiders, for the third party. It is not for debt holders. It is not for equity shareholders. It is for third party. So anyhow, we have to deduct the tax. One thing. Other thing, for coming to this EBIT, we have deducted operating expenses. We have deducted operating expenses, which includes non-cash expenses also, that is depreciation, provisions, amortization, right? So can you tell me that why depreciation, provisions and amortization, these are non-cash expenses? Why these are not considered as non-cash expenses? Because there is no actual outflow. There is no actual outflow of cash here. So we deduct it from profit, but there is no actual outflow of cash. That cash is in our hand itself. So in this EBIT, we have to add, in this net income, first we have to add, see here we have taken EAT, earnings after tax, as net income. Then we have to deduct tax, that's okay. But this, we have to come to a point, we have to come to that amount of cash which is available for debt holders also and equity shareholders also. So we have to add interest first. We have to add interest because we want to know how much is available for debt holders also. We don't pay principal to the debt holders, we pay interest to them, right? So we have to add interest first. So see, in formula, interest is added. I will tell you why it is net of tax, but for now, see, we have to add interest because we have to come to a point where we want to know the amount which is available for the debt holders as well as for equity shareholders. Okay, that's why we have added interest. Then non-cash expenses. That cash is available to us. It is deducted from profit. That's right. But we have that cash. It's not a real outflow. So we will add non-cash expenses also in EAT. And as I told you, we will also add interest net of tax. Okay. Minus working capital investment. Working capital investment. If there is any outflow due to working capital, if the balance of working capital was 50,000 in previous year, in last class I gave you the example, it was 50,000 in previous year and now it was 2,10,000. You can see this. So there is increase in working capital by how much amount? By 1,60,000. So we have this much of working capital now, 2,10,000. So this is a cash outflow. This is a cash outflow. So we will deduct it also. Working capital investment. We have invested 1,60,000 more for working capital. That's an investment. That means cash outflow. So here we are going to deduct working capital investment also. Not working capital of current year, change in working capital. I told you in previous year the balance of working capital was 50,000. Now it is 2,10,000. So how much change is there? 1,60,000. So we have invested more. We have invested 1,60,000 again in working capital. So we will deduct it also because there is a cash outflow. Then if we have done some capital expenditure, okay, we have bought some fixed asset or anything, so we will deduct it also because it is also cash outflow. That cash is not in our hand now, right? So this is how the formula came. Now can you tell me, can I write here instead of EAT plus interest, can I write EBIT? Because if I will add interest in EAT, it will come EBIT, but not tax. We don't deduct tax here. See, we can also write it as EBIT 1 minus tax. EBIT 1 minus tax. For this part, we can write EBIT 1 minus tax. How? See, for coming to EAT, we will deduct interest and tax. From EBIT, we will deduct interest and tax. And if we add back tax and interest, we will get EBIT. But we are only adding interest and tax is still deductible. Tax is still deductible, right? So can we write it as EBIT 1 minus tax? Instead of writing this, instead of writing net income plus interest 1 minus tax, can we write EBIT 1 minus tax? Can we write it? Okay. Plus non-cash expenses minus working capital investment minus fixed capital investment. Okay. So we can write any one of the formula. Now one more thing. I told you that I will tell you why interest is net of tax. Why interest is net of tax. See, in EBIT, we deduct interest first. Then we come to EBT, earnings before tax, in which interest is already deducted. Okay. So, we pay tax on which amount? On EBT. We pay tax on EBT. So, interest is already deducted. Our income is already lowered. Now, we have less income because we have deducted tax interest from it. Now, on the remaining income, that is EBT, we pay what? We pay tax. So, come to example. For example, suppose there is no debt. There is no debt in a company. There is no debt and EBIT is 100 rupees. EBIT is 100 rupees. Okay. Minus interest will be 0. Minus interest, that will be 0. So it is 100 now. Our EBT is again 100. Earnings before tax. Minus tax 40%. Minus tax of 40%. So it will be 40 rupees. Now we have EAT. Our net income is 60 rupees. But consider one more situation in which we have interest also. So we have interest of 20 rupees. Make this figure 1000, 400 and 600. Okay. Now, in the second situation, this is situation 1, this is situation 2. EBIT is our 1000 rupees. Take interest 200 rupees. EBT will be 800 rupees. And when we less tax, now we have to deduct 40% tax. 40% of 800. 40% of what? 800 is 320. 320. So, what will be the final answer? What will be our EAT? It will be 480. It will be 480. Okay. So what is the difference in two situations? What is the difference? See, in situation 1, we paid tax of 400 rupees. We paid tax of 400 rupees. In situation 2, we paid tax of 320 rupees. So due to interest, we saved rupees 80. We saved rupees 80. This is our tax shield. This is called tax shield. We saved rupees 80 in our tax. We saved rupees 80 in our tax. Due to what? Due to interest. Due to interest, just because in situation 2 we deducted interest first, we saved rupees 80 in tax. So what will be the net cash outflow? We are paying 200 rupees. It is cash outflow. We are paying 200 rupees interest. It is cash outflow. But we also saved rupees 80. We saved rupees 80. So the net cash outflow will be 120 rupees. Net cash outflow will be 120 rupees. That's why whenever we take interest in a formula, whenever we add interest, we add it net of tax so that there is no double counting. The net cash outflow for interest is rupees 120 only, not 200 rupees, because we have saved 80 rupees from tax due to interest. That's why here we will take 120 instead of 200. 200 minus tax. Okay. So this is how our formula is derived. We have to take EAT as net income, the final net profit, plus non-cash expenses. Because there is no real cash outflow, we have that money in our hand. Profit is deducted, that's right, but we have that money in our hand. We have still that money. Okay, so there is no real cash outflow. That's why we are adding non-cash expenses plus interest, because we want to know how much is available for the debt holders also. So that's why we are adding interest back, because in EAT interest is already deducted, so we have to add it back. Minus working capital investment. If we have contributed to working capital, if we have invested in working capital, then we have to deduct it also, because there is cash outflow. Then fixed capital investment, because here also there is cash outflow. And instead of writing this formula, we can also write EBIT 1 minus T, because this here at this point we have cash for debt holders also and for equity holders also. Just we have to deduct the tax which we have to pay to the government, the third party. So EBIT minus tax will be considered same as net income plus interest less of tax. So it will be EBIT 1 minus T. To simplify the formula, we can write EBIT 1 minus T. That is EBIT net of tax is what? Is cash available for the equity shareholders and for the debt holders also. Plus non-cash expenses, we have to adjust the non-cash expenses, we have to add it back. Minus working capital investment. If we have invested more in working capital this year, that means change in working capital. Minus fixed capital investment. And I can write this formula in one more way. See, cash flow from operations. Minus interest 1 minus tax, minus interest 1 minus tax, minus fixed capital investment. See, here also it is given CFO plus interest net of tax minus fixed capital investment. Sorry, here it will be plus. It is CFO plus interest 1 minus tax. Now what is CFO? I told you in last class, CFO is cash flow from operations. So how it is derived? I told you in last class how CFO is derived. First we take net profit that is EAT plus non-cash expenses, and then we adjust change in working capital. In net profit we add non-cash expenses and we adjust change in working capital. Same thing we are doing here. In net profit we are adding non-cash expenses and we are deducting working capital investment. So instead of writing that, we can write CFO. We can directly write CFO plus interest net of tax minus fixed capital investment, because fixed capital investment is not considered in CFO, that is cash flow from operations. Working capital is considered because it is for daily operations. Working capital investment is for daily operations and cash flow from operations is the same thing. We are finding out how much cash flow is from operating activities, from day-to-day operations. So we are considering working capital, but we are not considering the fixed capital. Okay. So I hope you understood how this formula came, and we will learn it in detail in business valuation also. Okay, is it clear? What is the formula? I gave you the same formula in 3 different ways, but the meaning would be same. Meaning will be same. Is it clear to you all? If you have any of the doubts, you can ask me today itself. Please ask me today itself. Don't collect your doubts. This is approach number 1. This is approach number 2. This is approach number 3. We can write the same formula in 3 different ways. The meaning would be same. Meaning is same. Is it clear? Is it clear to you all? Is it clear why we are taking interest net of tax? Because we are saving tax from interest. We are saving tax because of interest. So we have to take the net outflow. I hope it is clear to you all. Please copy this, and this formula is given in notes also. So is it clear to you all? Same thing is given here. Same formula is given here also. FCFF is equals to NI, net income, plus non-cash expenses, plus we have to add interest, plus interest minus working capital investment minus fixed capital investment. Okay, is it clear to you? Please read it once. Please read whatever is given in the book once. I am giving you 1 minute. Then we will solve illustration number 4, which is related to FCFF only. Okay, so let's come to illustration number 4. Illustration number 4. The following information regarding ASA LLP is given. Here it is given cash flow from operations. Cash flow from operations is rupees 2050. 2050. Then interest expenses are given. That is 300 rupees. Also tax rate is given. So when we will take interest, we will take tax also. Interest net of tax. Then fixed capital investment. See, if fixed capital investment is given in positive, then we have to deduct. That means we have invested in fixed capital. But now here it is given in minus. That means we have sold our investment. We have sold our investment. If expenditure is negative, that means it is income. See, it is also written here, the company sold non-current assets for 500 rupees. So we have sold our investments. So there is cash inflow. So we will add it instead of deducting it. What we have to find out? We have to find out FCFF. It is not given in question. Please write calculate FCFF. Calculate FCFF. So what is the formula? We have to use that formula in which CFO is given. We will use this formula, the CFO one. So what is the formula for FCFF? CFO plus interest net of tax minus fixed capital investment. So CFO is given 2050 rupees plus interest is 300 less tax, that is 40%. We can also write it as 0.40. 40 divided by 100 is 0.40 minus fixed capital investment. So it will be minus here, minus 500. It is already given in minus, so we will take it in minus only. So 2050 plus 300 net of tax, 300 minus 40%, it will be 180. Then add 500 rupees because it is cash inflow. Minus minus plus, minus minus plus. Calculate it. Please calculate it. It will be 2730 rupees. The answer will be 2730 rupees. Is it clear to you all? Is it clear to you all? It was very, very simple. So in SPM, for FCFF and FCFP, we have to solve the simple illustrations only the formula based questions. Is it clear to you all? I hope it is clear. Now I am moving to the next topic, that is free cash flow to equity. Free cash flow to equity. Free cash flow to equity. See, in FCFF, it was free cash flow for the firm. I told you it is available for the debt holders also and for the shareholders also. We are not considering preference shareholders here. If we have to consider preference shareholders, we have to take preference dividend into picture. We have to take preference dividend also. We have to consider preference dividend also. But for now, we are assuming that there are no preference shareholders. There are only equity shareholders and debt holders. Okay. But what is free cash flow to equity? The cash which is freely available only for the equity shareholders. The cash which is available only for the equity shareholders, not for debt holders. Okay. So, free cash flow to equity. Free cash flow to equity. Is it visible to you all? Refers to the cash that is available only to the common shareholders. This means available only to the shareholders. So it will be free cash flow to the equity. Whatever cash we have in hand for equity shareholders, it is free cash flow to equity. Okay. So now let's come to the formula. The formula is almost same, but there is one change. Here we added interest back. In this formula we added interest back because it was we wanted to know how much cash is available for debt holders also. But now here we don't want to know how much is available for debt holders. We have paid them. Okay. We have paid them and we don't have to consider it back. We have already derived our EAT. We have already derived our EAT. So we don't need to consider the interest back. So it will be CFO minus fixed capital investment, same as the above formula, minus fixed capital investment. Now the change is only one thing. Change is about only one thing. We have to add the net borrowing. We have to add the net borrowing. Why? If we have borrowed something in this year, if we have borrowed something in current year, we have debt, we have to add here. Because why? Because that debt, we don't have to pay back it immediately. We don't have to pay back the debt immediately. That cash which we got from the debt, from the borrowing, we have that now. So for now, it is available for the common shareholders only. It is, the cash is available. Whatever we have took as debt, whatever we have borrowed, it is available now. For now, it is available for the equity shareholders only. We don't have to pay it back to the debt holders immediately. For now, we have that cash and we are going to use it for the shareholders, for the equity shareholders. That's why we are adding the debt here. We are adding the debt here because we don't have to pay back the principal immediately to the debt holders. We have that amount in our hand right now. So we are adding it back. We are adding it because it is available for the shareholders only. So one change is there in formula, that is CFO minus fixed capital investment. In CFO, we have already considered the net non-cash expenses and also the working capital is investment, minus fixed capital investment plus net borrowings. If we have borrowed something in current year, we are going to add it here because it is available now. Now it is available for shareholders only. So this was free cash flow to equity. Free cash flow to equity. Is it clear to you all? I hope it is clear. Please read it and then we will solve our illustration number 5, which is related to FCFE. What if instead of borrowing, we repaid the debt? When we will repay the debt, we will deduct it. But for now, in this, according to this formula, we have borrowed from outsiders. We have borrowed from the debt holders. But if we repay it back, if we are repaying it back, the company repaid the debt, then we will deduct it. Where there is cash outflow, it will be deducted. Where there is cash inflow, it will be added. Okay. So let's come to the illustration number 5. In illustration 5, what is given? Almost the figures are same from the previous question. CFO again 2050. Fixed capital investment is minus 500. That means the company sold its investments, its non-current assets. So it will be minus 500. And net borrowing is minus 600 rupees. That means we have repaid the debt. Instead of borrowing, we have repaid the debt. So come, let's find out FCFE. In question, please write calculate FCFE. Calculate FCFE. So what is the formula for FCFE? CFO minus fixed capital investment plus net borrowing. So what figures are given in question? CFO is 2050. Fixed capital investment is in minus. It is minus 500 because we have sold the non-current assets. Plus net borrowings. Plus net borrowings. Here we have repaid the debt, so it is minus 600. It is minus 600. If we are borrowing, we will add it. If we are repaying, we have to deduct it. So what will be the answer? 2050 plus 500 minus plus minus 600. Plus minus is minus. So it will be minus 600. It will be minus 600. Okay. So please compute it. Please compute it. Please calculate and tell me the answer. It will be rupees 1950. 1950. FCFE will be rupees 1950. So I hope you understood. I hope it is clear to you all. Very simple questions are given in book. If it will come in MCQ for 2 marks. Is it clear to you all? Is it clear? If you have any doubts, I'm telling you again and again, please ask me today itself. Don't collect your doubts for tomorrow. Otherwise, it will become a burden in exam time. Go through it once. Quickly read all the concepts related to cash flow statement and analysis. I hope you have copied the answers. I hope you have copied that. Now quickly read the whole topic, cash flow statement and analysis. And if you have any doubt, please ask me today. Is it clear? Any doubts? Okay. So cash flow statement and analysis is completed. Cash flow statement and analysis is completed. Now we are moving to the next tool, that is ratio analysis. Ratio analysis. I am erasing this part. I hope you have copied that. And if not, then don't worry. Answers are already given in your material. Answers are given in your material. Okay. So let's move to the next tool, that is ratio analysis. Ratio analysis. Ratio analysis, the last one. See what is given in book. Ratios express the numerical relationship between two or more things. The numerical relationship between two or more things. Somewhere I have given you the example of ratio when I was explaining you financial performance analysis. I gave you one example of asset turnover ratio. I hope you remembered that. I hope you remembered that. How ratios establish a relationship between the one item of P&L with one item of balance sheet. I told you that. So ratios express the numerical relationship between two or more elements. whether it is from balance sheet or P&L. It establishes a relationship between two or more elements. It plays an important role in determining the financial strength and weaknesses of a company. Through various ratios, we can find out the areas of strength and areas of weakness of a company relative to another company in the same industries. We can also compare two companies in the same industries through ratios. Ratios can be classified into, one second. Ratios can be classified into four broad groups on the basis of items used. So there are many kind of ratios, but in a broader classification, we can classify it into four types. So these are, first, liquidity ratios. Liquidity ratios, which shows the liquidity position of a organization, are liquidity ratios. Okay, we will learn all the ratios in detail. Okay, here I have given you all the possible ratios which are important for your exams. We will learn it in detail. Okay, for now just understand there are four classification. There are four types of ratios, that is liquidity ratios. The first one is liquidity ratios, which shows the liquidity position of an entity, how well the company is able to pay its short-term liabilities, its current liabilities, that is liquidity ratios, liquidity position. So liquidity ratios show the liquidity position of an organization. Okay. Then capital structure or leverage ratios. Capital structure or leverage ratios. You know that we can finance an organization through two things, debt and shares, debt and equity. Okay, debt and equity. So wherever there is debt, wherever there is preference shareholders, wherever there is equity, those ratios are capital structure ratios, which forms the part of capital. Are capital structure ratios. In whatever ratio you have, if it considers debt, equity, preference shareholders, they are capital structure ratios. Okay. Then profitability ratios. Whatever ratio you are having, if it contains profit, if it contains anything related to profit, then they are profitability ratios. Okay. If a ratio contains anything related to profit, they are profitability ratios. Gross profit, net profit, anything, profit after tax, they are profitability ratios, which considers the profit, any kind of profit. Okay. Then activity ratios. Activity ratios are also called as turnover ratios. Turnover ratios, which tells us about the turnover, which relates turnover to any other element. Okay, those are activity ratios. The main activity of any organization is what? Sales, that is turnover. So those ratios which include turnover are activity ratios, which establishes a relationship between turnover with any other element, are activity ratios. Okay, so these are the four kind of ratios. It is not that important. The thing which is important here is the formulas. I have tried to give you the major ratios which are important for your exams. And if anything is not covered here and any other ratios come in the question, then there only I will tell you the formula. If any extra ratio is given, I will tell you the formula for that also. So don't worry. First we have to learn whatever I have given you here. Whatever ratios are given here, first we have to understand that. So if I have to classify all these ratios into liquidity capital structure, profitability, and activity. If I have to classify, then see how I am going to do it. One more thing, the last ratios, all these ratios. One more kind of ratios are there. Those are investors ratio. Those are investors ratio related to the investment in the organization, related to the investors. Those are investors ratio which talk about the investors, the profit of investors, the dividend and everything. Those are investors ratio. So the last ones are investors ratio. It is extra. All other ratios are classified in these four categories. All other ratios are classified in these four categories. So let's classify all these ratios in categories. Four categories: liquidity ratios related to the liquidity position of an entity, capital structure related to the debt and equity, profitability ratios related to profit, then activity ratios related to turnover. So can you help me to classify? Can you help me to classify? I have already told you the meaning. So can you help me to classify? The first one is current ratio. It talks about current assets and current liabilities. So this is liquidity ratio. Liquidity ratio. It shows the liquidity position. Then quick ratio. It also involves quick assets and current liabilities. I will tell you the meaning in detail. Don't worry about that. First, we are classifying. It is also liquidity ratio. Anything related to the current assets and current liabilities, anything is always liquidity ratio, always comes under liquidity ratio. Okay. Then inventory turnover. I told you any ratio related to turnover is activity ratio. It is activity ratio. Then debtor turnover. It is also activity. Creditor turnover, again activity ratio. Then comes debt to equity ratio. Debt to equity ratio. Can you tell me which kind of ratio it is? Can you tell me? It is capital structure ratio, also called leverage ratios. Also called leverage ratios. So it is what it is? Capital structure ratios. Equity ratio is also capital structure. Debt ratio is also capital structure. Then gross profit margin. I told you profit ratios are about what? Which kind of ratios are profit ratios? Tell me, out of these four, in which category gross profit ratio would come? It will be profitability ratio. Then net profit margin. Again it is profitability ratio. Then comes total assets turnover. Total assets turnover. Again it is about turnover. So activity ratio. And then comes fixed assets turnover. It is again activity ratio. So that's how we have classified all the ratios into four categories: liquidity ratios, activity ratios, capital structure ratios, and profitability ratios. In the next class, I will tell you the meaning of all the ratios with the formula, along with the formula. And at last, all the ratios are related to the investors. Investors. These are investor ratios. See, what are investors ratios? Earnings per share, dividend per share. These are related to investors who have invested their money, how much they are earning, how much dividend they are getting. Then dividend payout ratio, how much proportion is dividend out of earnings. Earnings yield, what is the yield provided to the investors. Dividend yield, how much dividend is given to them, dividend yield. Price earning ratio, these all ratios are investors ratios. Okay, so in the next class, one by one I will tell you the meaning of all the ratios along with the formula, and then we have to solve one question, that is illustration number 6. We will solve it also. So I hope it is clear. The 4 categories are clear to you all, and we have also identified all the ratios into categories. Which ratio comes under what category? So we will meet in our next lecture. Until then, bye.